Can I let you guys in on a little secret that Wall Street just does not understand, nor do I think they can really comprehend? As you know, 10-year Treasury yields have risen dramatically since the Fed cut rates 50 basis points. This is because a Trump win is being priced into markets, and the 10-year Treasury is saying there's going to be higher inflation over the next 10 years because of a Trump win, and that is not going to allow the Fed to cut rates nearly as much as we otherwise would have. But let me tell you right now, that's bullshit. It's not true. And believe this or not, you could actually see deflation in 2025, which let's be clear, let's not hope for that. Deflation is worse than inflation, so you definitely don't want to see that. I guess the question would be at that point, are we getting deflation because the economy is crap, or are we getting deflation to reset some of the excess inflation we've seen over the past couple of years? And we won't know that until we see that. But inflation is going to be non-existent as a problem for the Fed, as a problem for the markets in that term. Because as the great Milton Friedman once said, corporations have always been greedy. They've always been greedy. They've never changed. Nothing has happened that made them more greedy. Consumers have always spent all of their money. That's a common theme throughout history in America. The one difference is government spending. Government spending is the variable that gives you inflation. And it's pretty clear, under a Trump win, we are going to have less government spending. He is going to hire Elon Musk, as is being reported, to cut costs in the government, which is going to create an issue for the Fed. Because less government spending, less inflation, means that the Fed officials that have been raising their targets for neutral are going to be wrong. In fact, mark my words, if Trump does win, as the markets are pricing in, so let's assume that is going to happen, because when you start to get markets and bond markets pricing something in, bond markets don't tend to be wrong. The bond market is larger than the stock market. Then I think more of a bull case scenario would be inflation starts to come in really low in the second half of 2025, and the Fed is all of a sudden going to be in a position where they are signaling these higher federal funds rates, these neutral rates that are almost 3% now. In fact, we could soon be returning to, as Jefferies, one of their head analysts, just said, that I shared you that clip yesterday, we could soon head back to 2019 federal funds rates, because the dynamics in the economy of innovation, of higher productivity, mean lower prices. And thus, in a bull case scenario for 2025, nobody really wants to talk about this, but we could actually see federal funds rates cut a lot more than expected, not because the economy weakens. Again, this is the bull case, but just inflation starts to come in really low. In fact, inflation, we're so used to inflation over the past couple of years. What's worse than inflation is deflation. And after you've seen so much inflation in recent years, you could start to see some deflation. Of course, are prices going back to 2020 levels? Absolutely not. And you would not want to see that. The economy would be in a bad place if that happened. But to get a couple inflation reports in a row, 2 or 3 of them, of negative 0.1% or negative 0.2%, minimal in nature, you could see the Fed start to drastically recalibrate Fed policy, and you could actually see a more easy money, easy monetary regime start to come about. Again, not because of super weak growth, super weak economic conditions, but just inflation dynamics. Think about an economy we've seen from 2016 through 2019, where you had average economic growth, slightly better than average economic growth, but good financial conditions, not overheated, but good conditions with very low inflation that allowed the Fed to stay near zero on the federal funds rate, like 1%, 2%, for that whole period. And I do think this is the bull case that not a lot of people are talking about right now. In fact, the bond market's saying we're going to have higher inflation under a Trump win, and I don't think that is accurate. I think we should at least start to consider the possibility of a Trump win, of lower inflation, and what that could do to markets. I think two sectors would benefit the most. There's two big ideas for next year. Number one is value. It's the value stocks that are trading at deep discounts compared to the tech sector, compared to the rest of the markets. These are cyclical names that would benefit from steady inflation levels, from a consumer that starts to feel a little bit better, maybe spend a little bit more, and lower federal funds rates. The other big theme, I think, for 2025, if the economy continues to do well, if federal funds rates are lowered, as I expect, because of lower inflation, it is AI. Now, not in the AI names that you would think right now, not NVIDIA, not the GPU providers, not a Cadence, not a Lam Research, not SMCI. Those stocks are, fully pricing in good news already. The areas in which I'm talking about are the AI appliers. These are software names that are using AI. This is something perhaps like a Tesla, right? This is data centers. Those are the areas that I think could have a really good 2025 if we do actually have the soft landing, which is priced in by markets. If we do have lower inflation and the Fed is able to cut rates more than expected in the second half of next year. Now, we also need to talk about this week. We do have a lot of earnings. We do have some economic data. But I did want to highlight this at the beginning of the video because I think Wall Street is getting way too far ahead of themselves, saying that Trump's going to cause inflation and that whole trade that's going on right now, it's going to be very short-lived and it's not going to be correct. So I think there's a big opportunity when markets are so swayed towards one outcome when it's clearly the wrong outcome. Now, again, the big question is, do we go into a recession or do we not? And unfortunately, I don't think we will know that until at least March, April, call it to midpoint 2025. When we get to mid 2025, I think we'll then have a better understanding of how the economy is going to hold up, if we are going to see a recession or if we're actually going to see a soft landing. And I think there will be bumps along the way. I think we will get a bad data report or two, and you will see some recession fears come up. Expect that to happen. I expect we'll get at least one, if not two corrections between now and probably April of 2025. With that said, this week really gets going a large chunk of the S&P 500 as far as earnings, okay? And as long as earnings do not come in bad for these companies, I think markets are going to go higher. We have to face the reality that earnings expectations have been dramatically lowered in recent weeks. It's like, it's ridiculous, honestly. You can't fight it because we don't make the earnings estimates or targets. But heading into this earnings season, Wall Street got a lot more negative on their actual estimates over the past couple of weeks. So the bar has been lowered dramatically. And it's going to make it look like this earnings season is great when in all reality, it's not going to be that good. We're only expecting 4% year-over-year EPS growth for the S&P 500, which does that justify where valuations are in the markets? Not traditionally. But as I explained in other videos now, I don't think you can look at the markets today and assign traditional valuation metrics to them. I don't think you can look at the last 50 years and say the S&P is traded at an average of 19 times earnings. We're trading at 26 times trailing 12-month earnings today. That's expensive. Or we're trading at, 22 times next year's earnings and say that's expensive because we printed so much money, $4 trillion. You now have AI, you have other factors that are kind of changing things. Look at how many retail investors are now in the marketplace. Look at the risk attitude around stocks. I don't think you can sit there and say the same valuation metrics in the past can apply to today. Just systematically, we are a more risk oriented investor class. Look at 2021. Look at some stocks that just run for no reason. I mean, look at this stock. This is not a typo on the screen. This stock went from $1 to $79 in this environment. It was a 4,000% return, I believe it was. The best return you've seen on a stock in a very long time for no reason, essentially. I think at least in the near term, as long as earnings come in better than expected, even though the bar has been lowered, that's going to be support for markets to do well in the near term. Nonetheless, for this week, Monday morning, you have some companies that are really not important to the markets. A lot of banks, capital management firms. Same is really true for Monday and after hours. You have SAP, SAP, Nucor, Berkeley, Logitech, Zions, AGNC, some other names, none of which are really going to be important for markets. Tuesday pre-market, Verizon, GM, 3M, RTX, GE Aerospace, Quest Diagnostics, Philip Morris, Sherwin-Williams, and Lockheed Martin that will report. Tuesday and after hours, you have Enphase, Seagate, Baker Hughes, Texas Instruments, and some others. Wednesday pre-market, Vertiv, Boeing, AT&T, Coca-Cola, Next Era Energy, GE, Veranova, Thermo Fisher, Boston Scientific, and General Dynamics. Wednesday and after hours, you have Tesla, Lam Research, IBM, Newmont, ServiceNow, QuantumScape, Viking, T-Mobile, Las Vegas Sands. Thursday pre-market, you have American Airlines, UPS, Southwest, NASDAQ, LKQ, Tractor Supply, Union Pacific, and a couple of others as well. And there's a lot of other names that also report earnings, but these are the ones that are, have the most analysts covering them, so on and so forth. Thursday and after hours, Dexcom, Decker Brands, Western Digital, Skechers, Boyd, Texas Roadhouse, Appfolio, and a couple of others. And then Friday, you have Colgate, New York Community Bank. I can't believe that bank is still operational. That's kind of crazy. Newell and Centene. Now, the big companies for this week, I think, are the ones that are cyclical, okay? UPS, that's going to tell us a lot. We had FedEx earnings. Those did not really paint the best picture. IBM, Lam Research, Vertiv, to a certain extent, they are all kind of grouped in that AI category. ServiceNow is going to be an important one, over $350 billion market cap name. That will also be important. Tesla is the largest cap company reporting earnings this week, but it's unclear if Tesla's actually going to move the broader markets. So again, as long as earnings do not come in as some kind of disaster, I think markets will do just fine. I mean, it's going to be hard to be a disaster when expectations are this low. And honestly, as Wall Street is chasing this market, I think that's a pretty powerful force. A lot of funds are saying, hey, this is seasonally entering the most bullish period of the year. We've underperformed the S&P. Now we want to leverage up a bit, get our returns up so we don't lose clients. That's kind of what you could start to see here, and why some people think we could even see 6,000 on the S&P before Thanksgiving. So in the near term, I don't think you want to bet against that, especially with earnings expectations that are this low. And really the big story of this week will be earnings, because if you look at the economic calendar, you really don't have anything for Monday. Fed Kashkari, Fed Schmidt, but that is it. Tuesday, you are going to get ECB President Lagarde that will speak, the money supply for September, Richmond Fed Manufacturing Index, Services Index, and Manufacturing Shipments Index, expecting those to be all negative, all super negative. Really, I don't think that's going to be a huge deal for markets at this point. Wednesday, you have Fed Bowman that speaks, existing home sales month over month, some oil data, Fed Barkin, Fed Beige Book that comes out at 2 p.m. The Beige Book, I do think, is something we want to watch. The Fed Powell kind of indicated that some of the data is just kind of bad recently, and the Fed Beige Book is kind of more of an accurate representation of what's actually going on in the economy right now. Now, Thursday, you're going to get initial jobless claims. That's going to be the biggest catalyst of this week. You're actually expecting that's going to go up from 241,000 last week to 245,000. Any any large spike is going to be a problem for markets. So we'll see how that comes in. Could be a nothing event, or it could be a really bad event, just depending on, how high that number is. Now, you will get the S&P Global Composite PMI, Manufacturing PMI, and Services PMI that will also come out at 9:45 in the morning on Thursday. You do get new home sales month over month and for September as well, and the Kansas Fed Composite Index, Kansas Fed Manufacturing Index that are both expected to come in really negative. So Thursday's definitely going to be your biggest day as far as economic data, although it's really initial jobless claims that's going to move the markets the most. Now, on Friday, you're going to get durable goods orders month over month. You are expecting negative 0.9%. Last month was 0.0%. So that would be a negative month over month number. Wall Street's not going to like that if that happens, but I think the estimate is already pretty negative, right? You're expecting negative 1%. I think there's a chance, especially before the election, that this is probably going to come in a little bit better than expected. So I actually think Friday's durable goods orders might turn into a good catalyst for markets. Although if we come in almost negative 1%, Wall Street's probably not going to like that. So we'll see. But lately, we've had a lot of funky data, a lot of weird revisions, weird payroll reports, and, well, I don't think that's going to change, at least until the election is over with. Call me jaded, call me confused, call me crazy, but that's kind of the trend I've noticed recently. So as far as the markets this week, honestly, I think it's going to be a good week. I'm not concerned internally from my perspective because of the way we're set up for earnings. Earnings are going to look like they're great, even though they're not. Wall Street tends to move higher. The markets, when earnings estimates beat, no matter where they're at, if it's a low bar or if it's a high bar, Wall Street just cares if you beat that bar. And we're going to beat that bar pretty handsomely. It's going to look like things are great. And that's probably going to move stocks even higher. As you do head into the seasonal period in the year, getting close to the end of the year, Wall Street's going to start chasing and trying to make up some of the returns that they missed out on earlier in the year by being underweight markets, by being defensive and not positioned in AI, so on and so forth. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.